Well, I'm very pleased to welcome you all here this morning, and it's my honor to introduce Tobias, old friend, and I guess not a collaborator, but we've certainly talked about an awful lot of things together over the years. Tobias spent quite a few years at the New York Fed, which was a very convenient location for this kind of collaboration. And now he is the financial counselor and director of the Monetary and Capital Markets Department of the IMF. This is a really central role, and they produce these estimates of what's going to happen in the global economy. And I think we're going to hear a little bit about that today. It's a real honor to have Tobias with us, and thank you.
Thanks so much, Dick and Rob, for having me here this morning. It's wonderful to be back in New York. I really haven't come up much during the pandemic, and so it's very good to be back at NYU, I think for the first time since before the pandemic. So very good to see lots of friends and former colleagues as well. So, you know, the theme of the conference today is on polycrisis risks. And so what I'm going to talk about is sort of like our global financial stability assessment, which is very much centered on the multitudes of risks that we are facing. So in particular, I'm going to talk about three main things. So I'm going to start with bank and non-bank risks, so a little bit more on the financial institution side. Then I'm going to go to more macro financial issues, in particular high inflation, monetary tightening, and macro risks. And then finally, I will go to fragmentation and what fragmentation means for financial stability. So three broad topics. You know, I'm at the IMF, and we do these global financial stability assessments. So this is sort of like an expanded version of the global financial stability assessments. If you want to go deeper into the issues, you can go to the IMF website. There's the Global Financial Stability Report that this year has 3 chapters, or this April has 3 chapters. The GFSR comes out in April and then in October. And so the chapter 1 is the overall assessment. Chapter 2 this time was on non-bank financial institutions in particular, and chapter 3 on geopolitics and fragmentation. So, you know, the sort of like broad overview, this is the only slides with bullets, everything else are charts. So the broad overview is that the financial system has been severely tested since October. So it's really the UK LDI episode that was sort of like the first instance of turmoil. And then, of course, in March, we saw turmoil in the banks, particularly in the US and in Europe. And, you know, markets have stabilized, have actually rallied since then. But we do assess that sentiment remains fragile. And of course, monetary tightening continues, and there could be further upside surprises to inflation and hence upside risk to monetary tightening and financial conditions. And so as a result, downside risks to the global economy are still elevated. And so, you know, one of the things that I'm going to talk about in a moment, so like in the second part of my 3-step presentation, is our kind of macro financial risk assessment, which we call growth at risk, which is linking macro financial vulnerabilities in a kind of forecast of downside risks. Of course, the crisis or the turmoil to date have been very much concentrated in advanced economies, UK, US, and Switzerland to date, but there are also risks in emerging markets, not so much the major emerging markets, but more smaller emerging markets and frontier economies in particular. So I'll talk about that a little bit as well. So let me start with the first section, which is on banking stress. And I'll talk quite a bit about non-banks as well. And, we have seen turmoil, but there could certainly be further turmoil. And so we'll look at various vulnerabilities that could be triggered by further tightening. So let's start with the March episode. So what we are showing here are the share prices for Credit Suisse and for SVB. And this is starting in May 2022, so about a year ago. And this is compared to the banking index for Europe and the US, as well as the S&P 500 and the Euro Stoxx 600. And I would point to three notable facts here. So the first one is that both Credit Suisse and SVB share prices were coming down quite a bit before the actual turmoil, right? So the market had picked up that something was not going well before. And I think in the case of Credit Suisse, that was well advertised, right? So it was well known that there were structural issues. The bank had not been profitable in some time. That was a well-known concern. SVB was perhaps less well-known, but shareholders certainly had seen concerns. And then there was, of course, in mid-March, the resolution and liquidation of SVB, and then the merger of Credit Suisse. And that did have a spillover onto the banking system more broadly, right? So there was certainly contagion across banks, but there was really very little impact on the broader stock market, right? So contagion to other banks, yes, but not so much to broader markets. And so we'll dig a little bit deeper for why that was the case. So basically, with stock prices going down sharply, of course, the cost of capital for banks went up quite dramatically, right? I think in the US, stock prices for banks went down between 25 and 30%, depending on how exactly you measure it. In Europe, about 20%. Of course, in Europe, there was a very sharp run-up prior to that. So, it's perhaps not as dramatic in Europe, but in the US, certainly you do see quite a bit of repricing of the cost of capital of banks. And that, of course, is going to have macro implications. I'm going to return to that in the second section. But it's not just the cost of capital in terms of equity capital, it's also funding in shorter-term markets that got more expensive. So here we're showing some of those funding spreads in the commercial paper market and in other money markets for Europe and the US. And clearly you see the stress in kind of funding markets that's very familiar from crisis episodes. And what is perhaps different this time compared to 2008 and 2020 is that the cross-currency funding spreads widened very slightly, but not very meaningfully. So there was very little contagion across borders. There was, of course, the sell-off in the US and Europe, but very little contagion to outside, to other markets, including to emerging markets. And so it was a banking crisis or a banking turmoil, really, in both the US and Europe, but not so much a spillover to other countries or contagion to other countries. And so why was the episode contained? And I would argue that on the one hand, vulnerabilities were high. So there was a lot of risk that realized, and it could have gone very badly. But there were also extremely powerful policy tools that got released. And you can see that here in one of those tools, which is discount window lending, shot up very quickly to magnitudes that surpassed both the COVID crisis and the 2008 crisis, right? So about 150 billion of discount window lending. And, in the US, there's another backstop for banks that hold, agency and mortgages, which is the Federal Home Loan Banking System. And so their borrowing also shot up quite markedly to, 250 billion. So those borrowings have come down to some degree. And of course, the Federal Reserve on the weekend of the SVB failure also announced a new lending facility called the Bank Term Funding Facility. And so the difference between regular discount window lending and the Bank Term Funding Facility is that at the discount window, you have to market your collateral. So you can bring treasury or agency collateral or even the loan book to the discount window, but it is market. And there's a haircut, right? Because the Federal Reserve has to protect the taxpayer against any potential losses. The Bank Term Funding Facility is a 13-3 facility. So it's an emergency lending facility that allowed borrowing against high quality collateral, so treasuries and agencies essentially, at par without a haircut, right? So that is pretty aggressive. The taxpayer was protected by using the Exchange Stabilization Fund of the US Treasury as a cushion against any losses, and by making this lending with recourse to the borrower. So if there were any losses, the Fed would have recourse to the remaining balance sheet of the borrower. But clearly it shows that, policymakers had a high level of concern and hence rolled out this facility, which is aggressive, I would say. It reflects, the level of concern. I will go to the discount to deposit insurance in a moment. And of course, what happened with SVB is that it was the bank for the tech industry, deeply embedded in Silicon Valley, and it had grown extremely quickly through deposits by technology firms that were flowing in. And basically, the bank couldn't lend as quickly, and so bought securities when interest rates were very low, right? Say in 2020, early 2021, etc. So the securities portfolio was increased, meaningfully. And then, of course, interest rates went up. Many of those securities were in hold to maturity portfolios, which are not mark to market. And so there were unrealized losses on the balance sheet, right? Because these are securities that are not mark to market. So you have unrealized losses. But then as the tech industry was cooling down in 2022, deposits were flowing out. And the bank had to start to realize some of those unrealized losses, which put pressure on the capital position. And hence, they tried to raise equity in capital markets. And that was the trigger. The trigger for the crisis was that they were not able to raise that equity. And that is that. So then what happened basically was that many of the corporate investors or the deposit holders in regional banks in the US went from deposits into money market funds, primarily into government and treasury money market funds. So you can see that there are about $500 billion of inflows into money market funds since the beginning of the year, and that accelerated very, very sharply since March. So just to give you a sense of magnitude, there are about 20 trillion of banking assets in the US. This sounds a little bit funny here. So about 70% of that is funded by deposits, and about half of those deposits are uninsured, so wholesale deposits. And so it was primarily those wholesale deposits that went from the banks into the money markets. So as a result of the failure, yields moved dramatically. So here we go back to the mid-1980s and show you changes in the 3-month euro-dollar rate and the SOFR rate more recently. And you can see that you have to go back all the way to Black Monday to see the kind of magnitude of changes in, what we usually think of as rate expectations. Of course, it's a mix of rate expectations and flight to quality. So a massive, massive repricing of interest rates, right? Because basically massive flight to quality into treasuries that are now mark to market in money market, due to money market fund holdings and other treasury holdings. So massive inflow into treasuries, yields collapse. And so that was really a collapse, not just at the short end, but at the entire, for the entire yield curve. So here we're plotting the policy rate path for the US and Euro area. And you can see that prior to SVB, so on March 9th, that is just before the SVB failure, you had a rate path in the US that was pricing, 5.5. And then within 1 week, the path shifts down dramatically, right? By over 100 basis points. The speed of repricing is really, really quite unusual. And that has reverted to some extent, but not all the way. And so why hasn't it come back all the way? I think there are two reasons. So one is that inflation surprises have been on the downside, right? So the proximate cause for the SVB pressures were upside surprises to inflation in late February and early March in the US, but also around the world. So the policy path had shifted up quite a bit, and that put pressure on those balance sheets. Then the SVB failure was this massive flight to quality. So the rate path shifts down dramatically, and then it goes back, but it doesn't go back all the way because, of course, now bank lending standards have tightened, right? The cost of funding for banks has risen dramatically. So some of the tightening that the Fed and the ECB would have had to do, is now being done by tightening of lending standards, right? So we'll look more at that later on. In the euro area, you also see this dramatic move, not quite as big in yield terms, but a very, very similar story. Also a move back, but not all the way. So, part of that are shifts in policy expectations, but of course, part of that is also flight to quality and amplification, so through liquidity issues. And so when you look at US Treasury market liquidity, here measured by depth in the book, you can see that liquidity, went to, illiquidity was very high. Depth collapsed and is very low by historical standards. And so here's again another plot here looking at 2-year yield changes. Those as well were extremely dramatic on the 1-day change. On the 1-week change, it's even bigger, of course. So markets were very illiquid, and volatility in the treasury market was extremely elevated. The VIX also came up quite a bit. And so equity market volatility has come down, equity valuations have come back up, but interest rate volatility remains high. So by historical standards, the MOVE index plotted here is at about 150, which is still extremely high by historical standard. This index goes back to 1988. It's sort of like a good proxy for market liquidity in treasuries. So illiquidity certainly also plays a role here. Now, more recently, of course, there's another theme in treasury markets that has come into focus, which are concerns about the debt ceiling. And so when you look at different indicators of stress related to the debt ceiling, you can see that, for example, the CDS spread for the US has come up to high levels at the one-year maturity here, for example. You know, when you talk to market participants, we have many here in the room today, there is quite a bit of liquidity nowadays in the one-year contract. Usually it's less liquid than the 5-year, but at the moment there's quite a bit of liquidity. So there are both trades on both sides. And you can see that that is quite a bit higher relative to earlier episodes of debt limit tensions. You can also see that there's some dislocation in the term structure of treasury bills. So this is now, the dislocation is now around June. It was earlier, later. So the dislocation has moved forward. You know, tax receipts were somewhat below expectations. And so the dating has come forward. And of course, another indicator of stress is that despite quantitative tightening, despite a runoff of the asset purchase portfolio of the Fed, the balance sheet size has come up because, of course, these emergency lending facilities have increased very sharply. So let's dig a little bit deeper about what has happened in the banking book and how that compares to other countries as well. So here we're looking at bank security portfolio holdings for the US, but also UK, Japan, Euro area, other advanced economies, Latin America, Asia, and other emerging markets. And so what you can see is that around the world, banks hold about 25 to 35% of securities. What is a little bit different in the US compared to other countries is that the share of debt securities in those securities is extremely high. So there's less in bills and more in longer term securities. So there's more duration risk. And so as a result, these unrealized losses in the US are much larger than in other countries. So here we're showing you the estimated impact on the CET1 ratios from unrealized losses in hold-to-maturity portfolios. And this gives you a cross-sectional distribution across the banking systems. So the 10th percentile, so these are the banks with the largest losses in the cross-section of banks in each of those countries. For the US, are literally off the chart. So these are about 700 basis points of losses that have to be subtracted from the CET1 ratio for the weakest, the 10th percentile of the weakest banks in the cross-section. Even for the median, you have a 250 basis point subtraction if you were to mark to market those hold-to-maturity portfolios. And so the US does look different from other countries, including it looks different from emerging markets. Now, what helps in the US is that, of course, deposit insurance is extremely high, right? So the limit in the US is 250,000. In Europe, it's 100,000. And when you go to emerging markets, you go to much, much lower levels. So here we are showing you box plots of deposit insurance coverage ratios for Africa, Americas, Asia, Europe. You can see there's a big cross-sectional distribution, but there's certainly some countries that have, very low coverage ratios. Of course, I talked already about the discount window lending, but the other very important and perhaps even more important tool in the SVB turmoil was the ability of the FDIC to resolve the bank and then to use a systemic risk exemption to make all depositors for SVB and Signature, another bank that failed that weekend, whole, right? So in the US, about 45% or so of deposits are uninsured. So these are basically the corporate deposits. And the Dodd-Frank Act allows the FDIC to designate a bank as systemically important and extend deposit insurance coverage to the uninsured deposits. And that's a provision that is generally not available in other countries. So that was extremely powerful in terms of containing contagion. Now, what about credit risk, right? So for the moment, I've talked about interest rate risk. But let's take a look at credit risk. And what you can see here is that NPL is actually trending down. We're looking here at the European Union and the emerging markets. The US looks very similar. Stage 2 assets, which are performing but close to non-performing, are trending up but are not extremely elevated. So this is quite different from 2008, which was all about credit losses related to housing markets. Now going to non-bank financial intermediaries. So, there is perhaps more concern about credit risk on the NBFI. So here, for example, we show you level 3 assets in the insurance sector. So those are the hard to value assets. So these are illiquid assets as per accounting standards. And you can see that there's quite a bit of increase in those level 3 assets. So these are, again, the distributions, the cross-sectional distributions of insurers. And you can see that some of them have quite a bit of these illiquid assets. Another metric to look at, for example, are the leveraged loans. They're about $1.5 trillion for the US. And you can see that, underwriting standards have been deteriorating in this area. Leverage is also elevated in the non-bank financial intermediary sector. So this is illustrated here by hedge fund leverage on the left-hand chart. So you can see, for example, for macro and relative value, a very sharp upward trend over the past 8 or so years in terms of leverage. So it went from about 15 to 1 to about 30 to 1. So quite a bit of leverage in the hedge funds that could be forced to delever at some point. And of course, LDI in the UK was all about pension fund leverage, right? And so here we are plotting pension fund leverage measured by derivatives over net assets for 2011 and 2021, so a 10-year change. And you can see that we went from a little bit over 100 to about 150 on average across countries. And for some countries, that increase in pension fund leverage in derivatives books has increased quite dramatically. So, here's the same plot again. And so could LDI happen elsewhere? Well, when you look at, like the fixed income share in defined benefit plans, which is the green one here, that is also elevated in other countries. So the UK is quite high, but other countries like Japan, Netherlands are quite high. US is lower. And some of those countries also have quite a bit of leverage in derivatives books. I'm not plotting the names of the countries here. Those pension funds own a very large share of domestic sovereigns in some countries. So there is, some potential for further turmoil here. So this was sort of like the institutional part of the presentation. Let me now move to the macro part. So this is the growth at risk and inflation kind of section. And so what we're using at the IMF as a baseline for macro financial risk assessment is what we call growth at risk. So this is plotted on the right-hand side. So growth at risk is the forecast distribution for global growth. You can do this for countries. It's centered around the real forecast, right? So we do forecast growth for every country 4 times a year. So the distribution is centered around that forecast, which comes from the country teams at the IMF. And then the forecast distribution is the density forecast 1 year out as a function of financial variables, financial conditions, and financial vulnerability. So like price-based and quantity-based measures of financial conditions. And so what you can see is that our metric for growth at risk, which is the 5th percentile of that forecast distribution, has not moved very much relative to last October. And so the reason is that, you know, financial conditions have not really tightened very much. So they eased prior to SVB. In the SVB crisis, they tightened a little bit, but they were still easier than in October. And since then, they have eased. So financial conditions haven't really tightened. Now, if you look at a severe downside risk scenario with basically a global recession and tighter financial conditions, you would see quite a bit more downside risk. But, you know, in the baseline assessment, the downside risk is, you know, very similar to last October. Now, of course, inflation is the underlying driver of financial stability issues. You know, financial crises are typically preceded by monetary tightening cycles, right? And so, you know, these are the swap implied 1-year forecasts for inflation. They had gone back to target basically in the US and Euro area. They came up sharply earlier in the year, and that was again the proximate cause for the SVB failure, but they're coming down quite quickly. So when you look at the density implied, so these are inflation swap implied densities 5 years out for the US and Euro area. There's a lot of information here. So kind of like a proxy for the unconditional density is the 2018 density here. This is 5 years out. And the US basically had moved to a mode around 4%, so twice the target in April 2022. But it has moved back to something very close to the 2018 density. So with the center around a little bit above 2%, but the mode is, you know, only very, you know, it is close to 2%, close to the forecast distribution. It's unimodal. It used to be bimodal. It's unimodal now. For the Euro area, you still have this bimodality, right? So at the moment, you still have a mode at 2% and a mode at 4% for the 5-year out, you know, market implied density. That is an improvement relative to last year. You see, you had a bimodal density with a huge mode around 4%. So it's better, but it's not quite as good as in the US. So, of course, you know, one of the best predictors for recessions is the term spread. So the 10-year 3-month spread is sharply inverted. You know, our baseline doesn't foresee a recession, but of course it is, you know, there's a high likelihood of a recession, and market observers like street economists, you know, continue to forecast very high likelihoods of recessions, though they have come down a little bit. Lending standards in the banks have tightened quite a bit here. That is for the US and the Euro area. And, you know, when we look at the impact on bank lending of the tightening of funding conditions in the banks, so to what extent is that sharp sell-off of bank share prices that we saw after SVB going to have an ultimate impact on GDP growth? We estimate that to be about 0.45 in both the US and Euro areas. So the sell-off of bank shares will have an ultimate impact on lending by the banks, And that is one rationale for why the policy path has shifted. Right? So, valuations remain very stretched. So global markets haven't sold out. So our, baseline assessment of the equity risk premium in the US remains very, very tight. And, it's not quite as tight in the euro area or Japan, but there's certainly quite a bit of risk in terms of sell-off to global markets. And of course, earnings per share are coming down, very quickly. The current cycle is coming down extremely quickly. So, there's ample, downside risk. We already have seen a realization of this downside risk in some sectors, particularly in real estate, which is, of course, more interest rate sensitive. So real estate investment trusts, for example, in Europe, US, and Asia have sold off very sharply. These are forecast densities, estimated forecast densities for commercial real estate. So for different segments of commercial real estate, and by historical standards, there's a lot of downside risk in commercial real estate. And of course, it's those regional banks that have particular exposure to those commercial real estate. In terms of emerging markets, there's a very large differentiation. So all the way back to 2014, you see a very stable emerging market spread for investment grade emerging markets. But for high yield emerging markets and frontier economies, you see a sharp widening of costs. So very much a story of differentiation. And so this is showing you the sovereign spreads across economies in emerging markets. And you can see that more and more emerging markets are sort of like in distressed territory with spreads above 700 or 1,000 basis points. So small, vulnerable emerging markets and frontier economies are in distress. And of course, we do a lot of work on that restructuring as well. Now, that is certainly worrisome. So when you look at frontier markets, for example, you can see that interest to revenue is going up sharply as financial conditions are being tightened. This is not the case for other emerging markets. So again, very much a story of weaker emerging markets. And you can see that there is some loss of market confidence, but again, this is very much differentiated across countries. And so, one thing I would like to point out, there are a number of PhD students here. We had a chapter last year on the sovereign banking nexus in emerging markets. So that was an analytical chapter on sort of like feedback linkages between the sovereign and the banks. And you can see that that sovereign banking nexus is deteriorating markedly across emerging markets. So we all remember the 2012 euro area crisis. So in emerging markets, there's quite a bit of action here as well. So let me finish. I have about 2 minutes or so, just giving you a flavor of the current analytical chapter. So that's our chapter 3 in the GFSR. This is on geopolitics. So talking about the theme that Dick alluded to, we are in a world with many risks, and fragmentation is one of the big concerns. So our question here is, to what extent does global fragmentation have an impact on macro financial stability? And so I'm going to show you a bunch of regression results. So basically, geopolitical tensions. So these are typically, so we're proxying them with voting behavior in the UN, right? And there's a long time series of that. So you have basically a panel of voting behavior in the UN. And so geopolitical tensions are associated with lower portfolio and bank asset allocations by investing countries, capital flow reversals, higher cost of funding for banks, weaker bank profitability, and disruptions to cross-border payments. So these are our analytical results. So these are based on regressions. And then the policy recommendations are basically to strengthen financial oversight, i.e. stress testing. You could imagine that you do stress testing relative to global fragmentation scenarios, right? and build adequate coverable buffers and safety nets to a world that could be more fragmented. And of course, strengthen international cooperation, but that of course is important but challenging. So here's some of the regression or results. So cross-border banking flows, for those that rejected the Ukraine vote in the UN, are markedly lower. So this is 20%, right? So this is dramatic. Cross-border debt flows to Russia declined by about 60%. This is between March and November last year, and portfolio investment relative to being more or less geopolitically distant. So we do sort of like these gravity regressions, right? So in geopolitical distance space, right? So not geographic distance, but geopolitical distance. And you can see, very, very significant, very large magnitude. So this is quantitatively large in terms of portfolio investment flows. And so then, we run a bunch of, panel regressions carefully that are described in the paper. Basically, you can see that the bank cost of funding significantly increases as a function of geopolitical distance, and that is more so in emerging markets than in advanced economies. Bank profitability goes down, and these are all like very large magnitudes, right? Profitability goes down by like 12% as a function of geopolitical distance, and bank lending is affected tremendously. So there is, tremendous macro-financial linkage. And so, cross-border capital allocation as a function of these bilateral flows, as a function of geopolitical tensions, again, for investment funds at 25%, banks 15%, overall about 10%. So very, very large effects here. Net capital flows to GDP, extremely large. So these are first order concerns. So with that, I hope that was sufficiently worrisome to kick off the conference.
Thank you so much for the insights. That's a big picture overview, that's for sure. And there are plenty of things to worry about. Do we have time for a question or two? Yes.
I've got a question. Okay. Just to reconcile the growth at risk, which was based on the financial indicators, which was pretty benign. But then you later showed the yield curve recession probabilities implicit seemed quite high. So it seemed like the yield curve wasn't going into your growth at risk forecasts.
Yeah, so basically what I showed you was the forecast density in October compared to April. So from October to April, there isn't a sharp deterioration. And basically what happened is that, markets continue to rally, right? So year to date, for example, the US equities are up 7.5 or 8%. Europe is up 15%. Interest rates on net are slightly lower, and spreads really haven't come up so much. So, financial conditions haven't tightened all that much, but of course, interest rates are higher. So on net, financial conditions are not that different. So the density hasn't changed that much. But when you look at the longer time series, and that's in the GFSR, the downside risk, so the 5th percentile in the time series since 2000 is at a fairly low level. So downside risk over a longer time series is at a fairly alarming level. Not as bad as in the 2008 crisis, but in the worst 20th percentile of the historical downside risk distribution So the 5th percentile is in the 20th percentile over time.
The yield curve inversion, I guess that.
So the yield curve inversion feeds into that. Absolutely, absolutely, yeah. So the yield curve inversion basically is one of the reasons why by historical standards it is very much on the, you know, it is low, but it's not as low as it could get if we actually enter the global recession, right? Because basically what happens is that, you know, equity markets are not strong forecasters, right? They collapse once you enter the recession. The yield curve does forecast, but once you do enter, you have a sharp tightening of financial conditions. So, yep.
Yeah, thank you. So I want to ask you a little bit of question. Yesterday I was in DC.
Yeah.
I don't know, you know, the ITIF, which is National Information Technology and Innovation Foundation, and it seems that DC is freaking out about China right now. So the senators were there, Todd and Cruz, and they agreed on industrial policy, the Republican and Democrat. It seems that they want to move away from the neoclassical theory. Do you think because of the geopolitical risk that we're seeing now from China, there'll be more regulation, more involvement by the government, not only in terms of regulating banks and financial institutions, but like getting more involved in investments, industrial policy? That was really crazy because they agreed that they need an industrial policy to senators.
So and there's politics and there's economics. So, you know, I think what we try to focus on are the economics, and basically the economic effects of geopolitical tensions are large. I mean, the data shows you it's large. The politics, as you report, are difficult, and you know, the war of Russia in Ukraine, the Russian war in Ukraine is certainly one of the root causes, but there are other reasons for geopolitical tensions. And one could certainly imagine scenarios where the tensions deteriorate further. Yep.
So you mentioned about the high interest rates risk, right? So sounds like if the Fed right now, I mean, market is expecting the Fed to aggressively cut the interest rate for next, you know, a year or so. But the Fed still talks about hiking rate. So what's the point for them to do it even now? Because everyone knows they're going to cut the rate very quickly, very soon.
Okay, so that's the last question. When I look at Rob, I think I can read his mind. So yes, you know, monetary tightening cycles basically follow this kind of pattern, right? So you have to tighten to make sure that aggregate demand slows down. And once it slows down, eventually you ease. But calibrating the endpoint correctly is sort of like, you know, what is the challenge? I'm looking at Don Cohn here, who has been in that business for, who used to be in that business for 30 years. I'm sure he's glad to watch it these days, right? So, you know, the difficulty is you have to achieve sufficient cooling down without over tightening, right? And so basically what markets are pricing in at the moment is a kind of immaculate disinflation, right? So inflation is coming down very quickly to target in both the US and Euro area, and you know, in other countries, there's some heterogeneity with a little bit more tightening, right? So the market is pricing in like, you know, only a couple of moves. I'm not going to give you any precision here. And so what is priced into markets is that that is going to be sufficient to bring inflation down, which will then allow the Fed to ease. But of course, there's a huge amount of risk around that, right? Because inflation could surprise to the upside again. You know, when you look at inflation, right? So total inflation is coming down quickly, but core inflation is not really coming down all that quickly. And of course, core inflation is a much better forecast for future inflation than total inflation. So, you know, it is to, you know, so markets are optimistic at this point, I would say. There is quite a bit of risk of further shifts in yields.
Tobias, thank you.